Welcome back to part 2 of the basics of investing. On the first part, we talked about why you would invest, which was to beat inflation, to increase your wealth, and just for fun, and it's a good challenge. And then we talked about the stages of investing, and we talked about those first 3 that really are where you ought to be in the next year to 2 to 5. And then we ended up talking about types of risk, which are still here on the screen. So let's carry on with the last section here for 16.1, and it's regarding investment strategies. So people have a lot of excuses of why they don't invest, and they often just say it's because they don't have enough extra money or things like that to invest. But you need to start it just as soon as you possibly can and continue to invest over your lifetime. As far as the amount of money, even if it's $5, it's $10, it's $20 a paycheck, start now because that will really grow and we'll start to see how that happens. And also, if you should come into a large sum of money, be it inheritance or other means, a life insurance settlement, something, take that money and get it invested. Like when my father passed away and I got an inheritance that was a pretty decent chunk of change, I treated myself first and bought a new car, and that new car brought me a lot of joy and had value, but that value diminished within 2, 3, 4, 5 years. Whereas the rest of the inheritance that he gave me, I put in an investment account and is really what's helping me grow my wealth to the extent so that I can hopefully retire at an earlier age than expected. So it's probably helping me retire more at age 55 instead of 65 because of the amount that has grown through investing. So try to do that if something happens and you get money, that you put it aside and invest it so that it can grow after you maybe treated yourself to something first. So the criteria for choosing an investment is these factors or these criteria. And I want to talk a little about each of them. So the first one is the degree of safety. So we said that everyone has a different risk tolerance, and if you're not able to accept much risk, then you want to try to find safe investments. If you're willing to take on more risk, you don't need the safety. It can be a riskier investment. The degree of liquidity is a big one. So liquidity, for those of you that don't know what it is the ability to convert it to cash. So if I have money in a checking account, we already said it's a demand deposit. I can go get the money as soon as a check is presented. Savings is close to that. I can go right into the bank and get it. But for stock, I have to be able to sell the shares, so it's not as liquid as a checking account or as liquid as having cash already. And real estate, not very liquid because it's difficult. You have to, get the real estate ready to be sold, find buyers, sign agreements, and transfer ownership. So it's not easy or liquid either. The third criteria is expected dividends or interest. So you get dividends on stock. They're not all stocks will pay dividends. They're not obligated to. So you want to kind of look at the history of whether they do or not. And then, is it an interest-bearing investment such as a bond, which we won't go into. So figuring out how much that interest is going to be and what's expected. The fourth criteria is the expected growth in the value that exceeds the inflation rate. So making sure that if I buy stock at $10, that it's going to hopefully appreciate greater than what inflation is so that I'm starting to build wealth. Then the fifth thing is the reasonable purchase price and fees. So I want to get it at a good deal and I don't want to pay an investment broker or a real estate person fees associated with it if I can help it. And then there's lots of different tax advantages, which we won't even begin to go into, but those are things that we look at when we're trying to decide how to invest. The most important, though, things, I guess, are things that I want you to know about as it relates to choosing these investments, is that there is not an investment that has a high degree of all of these things. So there's not an investment that has a high degree of safety, liquidity, dividends, purchase price. So there's like a little trade-off that's happening. So a diversified portfolio that we talked about would have a balance of these factors. So it would have a balance of really safe investments, really liquid investments, things like that. And the rule of thumb really that you need to know is that you just want to pick the investment that has the highest degree of safety for what return you want. So if you're wanting big returns and you have 2 or 3 different investments that are possible, you want to get the safest of those investments that will still give you the amount of return that you want. So hopefully that makes sense. So there are some really wise or smart investment practices that you can do. So the first thing that you want to do is define your financial goals. You want to know how much money you want and when you want to have that money. So for me, I'm kind of in retirement planning mode. So I know that I want X amount of money by the time I'm 55 so that I can go on an around the world cruise on biking, and so that I can play pickleball and I can do the things that I want to do. So I've defined how much that's going to require and when I need to have it so that I have that goal in mind. The next practice you should do is go slowly. And when we talk about going slowly, we're really talking about doing temporary investments. So investments that need to be reevaluated in a year or less. So I'm going to put just a little money aside, see how it's going, reevaluate it, be able to change my mind, go in a different direction. So that's what we mean by go slowly. The follow through is when we're talking about the other kind, the permanent investments. So those are investment choices that are going to be held for the long run, 5 or 10 years or longer. Because as we said, investing is for the long term. So I ultimately want to follow through and go with longer term horizons to do my investments. Keeping good records is important. So any of your statements that you get from your brokers or anything like that, I, for one, do not keep any of that stuff except electronically. I have a file because I know that my broker also keeps files of all of the buys and sells and returns and tax documents and things that I need. But you're the one responsible if they're your investments, so make sure that you choose someone that can help you with that or keep them yourself. The next thing is to seek good investment advice. So good investment advice. Find a trusted person, a trusted business that you can go to talk to. These can be your own personal people, but it also ought to be brokers and things like that. And this person needs to be someone that you're really comfortable in telling them that you don't understand what that investment's doing, how it's helping you meet your goals. Ask questions, ask questions, ask questions. Because you need to make sure that you understand it too before you can direct them to do what you want from an investment standpoint. Keep your investment knowledge current. So the economy is really what drives everything related to investing. So if you don't know what's going on in the world economically, you don't have a chance of doing that. So watch the news, read, talk to people, make sure you stay up to date on that stuff. And then know your limits. We all, again, have very different risk tolerance, and you don't want to get involved in investments that are beyond your risk tolerance. So I'm a relatively moderate to low risk kind of tolerant person in investing. So for me to get involved in day trading and penny stocks and risky real estate, futures, options. I don't want to because that's just not worth it to me. It's too much anxiety. So I don't need that. So make sure you know kind of where you lie on that. And then if you really kind of in the next few years want to think about getting more aware of what's going on in the investing world and how it works at a low risk, soft landing if you screw up kind of thing, join an investment club. Get with some like-minded people, see how they evaluate things, learn an awful lot before you start risking a whole lot of your money. So that is the choosing an investment section.